Let me tell you about the biggest financial mistake I ever made. 1977, Dunkin Donuts. I bought the stock at 50 cents a share. The company was doing great. Every morning I'd stop by on my way to work. The place was packed. Coffee was excellent. Service was fast. The math looked perfect. Price to earnings ratio was 8. They were opening new stores, growing at 25% a year, profit margins at 18%, low debt. I bought the stock. 6 months later, it hit $3 a share, 500% gain. Everyone around me was saying, "Peter, congratulations, what a brilliant investment, you're a genius." So I sold. I walked away with a 500% return in 6 months, feeling pretty smart about myself. Today, that same stock is worth $150. That decision to sell at $3 cost me over $10,000. Actually, if you factor in everything, lost opportunity, compounding, it cost me closer to $150,000. And here's what I want you to understand. I wasn't stupid. I wasn't reckless. I did exactly what most investors do. I made the single most common mistake in the stock market. And if you've ever sold a winning stock too early, if you've ever watched a stock keep going up after you sold it, if you've ever said, "I should have held on longer," then you need to listen to every word I'm about to say, because this mistake, this one mistake, is the difference between people who get rich in the stock market and people who stay broke forever. Now, before we go any further, let me be clear about something. This isn't about how to pick stocks. That's not the hard part. Most investors can find good companies. The hard part is what you do after you buy them. I spent 13 years running the Magellan Fund at Fidelity. We went from $18 million in assets to $14 billion. Annual returns averaged 29%. We beat the S&P 500 by a massive margin year after year. And you know what I discovered? The average person who invested in my fund lost money, not because the fund did badly, the fund did great, but because they bought high, got scared, and sold low. They had terrible timing. But there's an even bigger problem. Even the investors who made money, they made far less than they should have. Why? Because they sold too early. I watched this happen thousands of times. An investor would buy a stock at $10. It would go to $15. They'd sell, feeling proud of their 50% gain. Then they'd watch it go to $30, to $50, to $100. And they'd realize they made $5 when they could have made $90. This is what I call the early exit trap. Let me explain the psychology of what happens. You buy a stock, you do your homework, you believe in the company, the stock goes up. At first you're thrilled, you're vindicated, you were right. But then something shifts. The gain starts to feel too good. You start hearing voices in your head. It's gone up too much. It has to come down. I should take my profit while I can. What if it drops? I'll lose everything I gained. Other stocks might do better from here. These thoughts feel rational. They feel like prudent risk management, but they're actually fear dressed up as wisdom. Let me tell you what's really happening. When you sell a winning stock, you're making a prediction. You're predicting that the stock won't go higher from here. But what's your prediction based on? Usually nothing. Usually it's just fear of losing what you've gained. Here's what nobody tells you about making money in stocks. The money isn't made in the buying. It's not even made in the holding. The real money is made in the not selling. Let me tell you the full Dunkin Donuts story, because the details matter. It's 1977. I'm working at Fidelity, analyzing companies, trying to find good investments. And every single morning, I stop at this Dunkin Donuts near my office in Boston, and I start noticing things. The line is always long, not just busy, packed. People are happy to wait. The coffee is good. The donuts are fresh. The prices are reasonable. Nobody's complaining. So I do what any investor should do. I start asking questions. I talk to the manager. "How's business?" "We can't keep up," he says. "We're selling out by noon most days." I look at the numbers. I pull the annual report. Here's what I find. Price to earnings ratio, 8. That's cheap. A PE of 8 means the market thinks this is a mediocre company. But I'm standing here watching a great company. Growth rate, 25% per year. They're opening new stores all over New England. The model works. Every new store is profitable within months. Profit margins, 18%. That's excellent for a food business. They're not just busy, they're making good money on every sale. Debt, low. They're not over leveraged. They can survive a downturn, so I buy the stock at 50 cents. Now here's where the psychology gets interesting. For the first 3 months, nothing happens. The stock just sits there. 50 cents, 52 cents, 48 cents. Boring. I start to wonder if I made a mistake. Maybe everyone else is seeing something I'm not seeing, but I keep going to that Dunkin Donuts, and it's still packed. The fundamentals haven't changed, so I hold. Month 4, the stock starts moving. 55 cents, 60 cents, 75 cents. Month 5, it hits $1. I've doubled my money. Month 6, it's at $3. I've made 500%. And this is where I screwed up. Everyone around me is impressed. Peter, that was a great trade. Time to take profits. My boss looks at the position and says, nice work, but don't get greedy. That kind of gain doesn't last. And there's a voice in my head saying, this is too easy. Something must be wrong. So I sell. I sell at $3, walking away with a 500% gain in 6 months. I feel like a genius. But here's what I should have done. Here's the question I should have asked. And this question will change your entire investing life if you actually use it. Before you sell any stock, you must ask 3 questions, only 3, but you have to answer them honestly. Question 1, has the story changed? When I bought Dunkin Donuts, I bought it for specific reasons. Great product people loved. Stores were always busy. Management was opening new locations. Profit margins were strong. The business model worked. When the stock hit $3, had any of that changed? No. The stores were still packed. They were still opening new locations. The coffee was still good. The profit margins were still 18%. Nothing had changed except the price. The story was the same. Actually, the story was better because more people knew about them. So why was I selling? Because I was looking at the price, not the business. This is the biggest mistake investors make. They confuse the stock price with the company value. The stock price is just what other people are willing to pay today. Company value is what the business is actually worth based on its cash flows, its growth, its competitive position. When the story hasn't changed, the price going up is not a reason to sell. It's often a reason to buy more. Question 2, is the valuation crazy? Okay, so the story is still good, but maybe the stock got too expensive. When I bought Dunkin at 50 cents, the PE was 8. When it hit $3, what was the PE? About 15. Now, is a PE of 15 expensive? For a company growing at 25% a year with 18% profit margins and a proven business model? No. A PE of 15 is still cheap. Fair value for a company like that is probably 20 or 25. If the PE had gone to 50, okay, maybe I should think about selling. But 15, that's still in the reasonable range. I've seen this pattern hundreds of times. A stock doubles and people assume it must be expensive now. But if earnings also doubled, the valuation might be exactly the same. You can't just look at the stock price. You have to look at the price relative to what the company is earning. Question 3, do I have a better place to put the money? This is the question that kills most investors. They sell a good stock because they see some other stock that looks exciting. When I sold Dunkin at $3, where did the money go? I bought 3 other stocks. They were fine. They did okay, but none of them did as well as Dunkin would have done if I'd just held it. Here's the brutal truth. Finding one great stock is hard. Finding 2 great stocks in the same year is almost impossible. If you found a winner, why would you sell it to buy something you know less about? I'm not saying never sell. I'm saying don't sell just because you're bored or because you think something else might be better. You sell when the story breaks, when the business deteriorates, when the valuation becomes absurd, or when you find something that's genuinely, obviously better, but I've made enough money is not a reason. It's gone up a lot is not a reason. Let me show you what happens when you get this right. Let me tell you about the stock I didn't sell too early. 1985, Home Depot. I discovered this company the same way I discovered Dunkin Donuts, by using it. I'm doing a home improvement project. I go to Home Depot on a Saturday morning. The place is a zoo, packed parking lot, long lines at checkout, but people aren't complaining. They're buying, loading up their carts with lumber, paint, tools, everything. I walk around, I watch. I notice the staff actually knows what they're talking about. They're helping customers solve problems. The prices are good. The selection is massive. I think this is a great business, so I do my homework. The stock is trading at around $15. PE ratio is about 15. They're growing at 35% a year, opening new stores across the South and West. Profit margins are solid. I buy. Now here's what happened next. Year 1, 1986. The stock goes up 40%. It's now at $21. People tell me, Peter, you should sell. Take your profits. I ask myself the 3 questions. Has the story changed? No. I go to Home Depot every few weeks. It's still packed. Is the valuation crazy? No. PE is still around 17, growing at 35%. Do I have a better investment? No. So I hold. Year 2, 1987, the market crashes. Black Monday, October 19th, the worst single-day crash in history. The market drops 23% in one day. Home Depot drops 30% in the panic. Everyone is screaming, sell everything. I ask the 3 questions. Has the story changed? I go to Home Depot, still packed. People are still doing home improvement projects. Maybe even more now because they're trying to save money by doing it themselves instead of hiring contractors. Story hasn't changed. Is the valuation crazy? The PE just dropped from 18 to 12. It's cheaper than when I bought it. Do I have a better investment? In a market crash, everything's cheap, but I already own this. Why sell? I hold. Actually, I buy more. Year 3, 1988, market recovers. Home Depot goes up 50%. Year 4, 1989, up another 45%. Year 5, 1990. A recession hits. Stock goes sideways. People tell me to sell. I ask the 3 questions. Story is fine. Valuation is fine. I hold. Year 6, 1991. Economy recovers. Stock up 60%. Year 7, 1992. Up another 30%. Total return over 7 years, 3,000%. If I had put $10,000 into Home Depot in 1985 and just held it through 1992, I would have had $300,000. Same amount in Dunkin Donuts if I'd held from 1977, over $300,000 as well. But I sold Dunkin at $3. I made $5,000 and missed $295,000. You see, the problem isn't finding good companies. The problem is holding them long enough for the magic to happen. Let me tell you why this happens, why smart people, educated people, people who do their homework still sell too early. It's not stupidity, it's biology. Fear, 1. Loss aversion. Human beings are wired to fear losses more than we enjoy gains. If I give you $100 and then take away $50, you're not happy that you still have $50. You're upset that you lost $50. When a stock goes up, this wiring kicks in. You're not thinking, this could go higher. You're thinking, what if I lose what I've gained? So you sell to lock in the profit. You're trying to avoid the pain of watching it go back down. But here's the flaw in this logic. If the business is still good, a temporary drop is just noise. It's not a loss. It's an opportunity. When Home Depot dropped 30% in 1987, I didn't lose anything. The business didn't get 30% worse overnight. The market just panicked. People who sold locked in a real loss. People who held recovered everything and more. Fear 2, regret. You're afraid that if you hold and it drops, you'll regret not selling at the top. But let me tell you about regret, real regret. The people who regret things 20 years later are not the people who held a good stock through a drop. The people with real regret are the ones who sold Walmart in 1980, Microsoft in 1990, Amazon in 2000. They sold because they were up too much. I promise you, nobody says on their deathbed, I wish I had sold Home Depot sooner. They say, I wish I had held it longer. Fear 3, the need to do something. This is the most dangerous one. Investors feel like they need to be active. If they're not buying or selling, they feel like they're not working. But in investing, doing nothing is often the best move. There's a reason I call my investment style lethargy bordering on sloth. When you find a good business at a good price, your job is to sit there and let it compound. Don't mess with it. Fear 4, comparison. This one kills people. You're up 50% on a stock. You feel good. Then you see that some other stock is up 100%. Suddenly your 50% feels inadequate. So you sell your 50% winner to chase the 100% winner. But here's what you don't know. That other stock might drop 50% next month. Your stock might go up another 200% over the next year. You traded a bird in the hand for 2 in the bush. And the bush is on fire. Stop comparing. Stop looking at what everyone else is doing. The only question is my stock still a good business at a reasonable price? If yes, hold. Now let me show you exactly how to avoid this mistake. I'm going to give you a system, a checklist, something you can use every single time you're tempted to sell. Here's my system. I call it the Lynch hold test. Every time you're thinking about selling a stock, pull out a piece of paper, write down the following. Part 1, the story checklist. Write down why you bought the stock in the first place. For Dunkin, my list was product, people love stores, always busy, expanding to new locations, strong profit margins, low debt, good management. Now, go through each item. Has it changed? If all items are still true, the story is intact. Don't sell. If one or two items change, but the core story is still strong, you probably hold. If 3 or more items changed, especially the core reasons, maybe it's time to sell. Part 2, the valuation check. Look at the current P/E ratio. Is it more than double what it was when you bought? For example, bought at P/E of 10, now at P/E of 25. That might be okay if growth accelerated, but if it's at P/E of 40 or 50, you should be cautious. I use a simple rule, PEG ratio. PEG equals P/E divided by growth rate. If the PEG is under 1, the stock is cheap. If it's between 1 and 2, it's fair. If it's over 2, it's expensive. If it's over 3, it might be time to sell. Part 3, the opportunity cost test. This is the hardest one. You need to identify a better investment, not just, I think this other stock might do well. You need a stock that you understand just as well, that has a better story, better growth, and better value. If you can't find one, don't sell. Most of the time, you won't find one. That's why most of the time, the right answer is hold. Part 4, the personal circumstances. Check. There are valid reasons to sell that have nothing to do with the stock. You need the money for an emergency, you're retiring, and need to shift to income-generating investments. The position has grown to be 40% of your portfolio, and you need to rebalance for risk management. These are fine. This isn't about never selling. It's about not selling for bad reasons. I've made enough money is a bad reason. It's gone up a lot is a bad reason. I'm nervous is a bad reason. Now let me show you what happens when you apply this system over a lifetime. Here's a mathematical reality that most investors don't understand. The real money in investing isn't made from picking the right stocks. The real money is made from the second and third and fourth year of holding the right stocks. Let me show you with actual numbers. Scenario 1, the take profits investor. Year 1, buy stock at $10. It goes to $15, sells for 50% gain, has $15. Finds another stock, buys at $15, goes to $22, sells for 47% gain, has $22. Finds another stock, buys at $22, goes to $30, sells for 36% gain, has $30. After 3 years, 200% total return. Feels pretty good about himself. Scenario 2, the hold and ignore investor. Year 1, buys stock at $10. It goes to $15, holds. Year 2, stock goes from $15 to $25, still holds. Year 3, stock goes from $25 to $50, still holds. After 3 years, 400% total return, double the return of the first investor. But here's where it gets crazy. Year 4 to 7, investor 1 keeps churning. Maybe he averages 40% a year with his trading. After 7 years, his $10 becomes about $100. Investor 2 holds the whole time. After 7 years, his $10 becomes $300, triple the return. And this is being generous to investor 1. In reality, he's paying taxes on every trade. He's paying trading fees. He's making mistakes on some of his stock picks. Investor 2 paid 0 taxes until he finally sells. 0 fees beyond the initial purchase. Made 0 mistakes on stock picking after the first one. This is why I say, in the stock market, the less you do, the more you make. Here's the secret most people miss. A stock that goes up 50% in year 1 is telling you something. It's telling you the market is starting to recognize what you saw. Other investors are figuring it out. But the big money comes when the institutions wake up, when mutual funds start buying, when it gets added to indices, when momentum builds. That doesn't happen in year one. That happens in years 2, 3, 4, 5. The first 50% is just the warm-up. The real move comes later. But you have to be in the seat to ride it. Every time you sell and buy something else, you're jumping off one rocket that's about to take off to jump on a rocket that might not even have fuel. Let me give you one more example. This one is about what happens when you hold through the scary times. Philip Morris. This was one of my best investments ever. I bought it in 1985, tobacco company, controversial, sure, but the business was incredible. Strong brand loyalty. Marlboro was the top-selling cigarette. High profit margins, lots of cash flow, and it was trading cheap because everyone hated tobacco companies. I bought in at around $7 per share, split adjusted. For 2 years, nothing happened. Stock just bounced between $6 and $8. People ask me, Peter, why do you own this? Tobacco is dying. I'd say, maybe. But right now, people are still smoking, and Philip Morris is making money hand over fist. Then 1987, the crash. Philip Morris drops to $5. People tell me, sell, it's going lower. I ask my 3 questions. Story, people still smoking. Marlboro, still the top brand. Cash flow, strong. Valuation, PE now at 9. Cheap. Better investment? No. I hold. I actually buy more. Then something interesting happens. 1988, stock goes to $10. I'm up 43%. 1989 goes to $15, up 114%. 1990, recession hits. Stock drops to $12. People tell me to sell. I hold. 1991, back to $20, up 186%. 1992 goes to $30, up 329%. By the time I'm done managing Magellan in 1990, Philip Morris has been one of our top performers. But here's the crazy part. If I had held it through the 1990s, when the stock really took off, that $7 would have turned into $70 plus before the tobacco lawsuits came. A 900% return became a 10 times return for people patient enough to hold. But most investors sold at $15 or $20 because they were up too much. Good businesses go through rough patches. The market gets scared, the stock drops. That's not a reason to sell. That's often the reason to buy more. If the business fundamentals are still strong, temporary drops are gifts. But you have to train yourself not to panic. Now, I know what you're thinking. Peter, this sounds great, but how do I actually do this in real life? How do I keep myself from selling? Here's my system for staying disciplined. Rule 1, write it down. When you buy a stock, write down on a piece of paper. I bought stock on date for price. I bought it because, list your reasons. I will sell if, list what would make you sell. Put that paper in a drawer. Don't look at the stock price every day. Check once a quarter. Pull out the paper. Ask, have any of my sell conditions been met? If no, close the drawer. Don't sell. This simple act removes emotion. You're not reacting to the price. You're evaluating the business. Rule 2, the do nothing calendar. This is something I use. When you buy a stock, mark your calendar 1 year from that date. Before that year is up, you're not allowed to sell for profit-taking reasons. You can only sell if something fundamentally breaks. This forces you to think in years, not days or weeks. Most big winners don't even get started until after the first year. Rule 3, the 2x and hold rule. Here's a trick that works for people who can't stop themselves from taking profits. When a stock doubles, sell half your position. Now you've taken out your initial investment. Everything left is free money from the market's perspective. This satisfies your psychological need to take profits while keeping you in the game for the big move. I don't love this strategy because you're still selling too early, but it's better than selling everything at 2 times. Rule 4, track your mistakes. Keep a journal of every stock you sold in the last 5 years. Write down what price you sold, at why you sold, what the stock is trading at today. This is painful. You'll see all the money you left on the table, but it's the best teacher. After you see yourself make this mistake 3 or 4 times, you'll stop doing it. Rule 5, ignore the noise. Stop watching CNBC every day. Stop checking your portfolio every hour. The more you look, the more tempted you are to act. Remember, the stock market is designed to transfer money from the active to the patient. Every time you trade, you're giving away your advantage. Let me tell you one final story. This one explains everything. I bought Walmart in 1980. It was a regional discount retailer based in Arkansas. Nobody on Wall Street cared about it. It's just a store in the middle of nowhere. But I visited, I talked to Sam Walton, I watched customers. The business model was brilliant. I bought it at around $4 per share, split adjusted. For the first year, the stock went nowhere. Actually, it dropped to $3.50. I bought more. Then it started moving. $5, $6, $8, $10. At $10, I'm up 150%. People tell me to sell. I don't. $15, $20, $30, $40. By the time I leave Magellan in 1990, Walmart is at $50. I'm up 1,150%. If I had sold at $10, taking my 150% profit, I would have missed the next 400%. But here's the insane part. Today, Walmart trades at around $160 per share. That original $4 investment is now worth 40 times more. A $10,000 investment would be worth $400,000 today. But most people who bought Walmart sold at $8 or $10 or $20. They sold because they were up too much. They missed one of the greatest wealth-building opportunities in history. Not because they couldn't find the stock. They found it. They bought it. They just couldn't hold it. This is the secret that separates the rich from everyone else. It's not intelligence. It's not luck. It's patience. I want to end with something important. This isn't about being stubborn. This isn't about never selling. There are absolutely times when you should sell if the fundamental reason you bought the stock no longer exists. Example, you bought a restaurant chain because their food was great, then the CEO leaves, quality drops, customers stop coming, sell. If the PE goes to 50 or 100 and the growth rate doesn't justify it, if a stock trading at 10 times earnings goes to 40 times earnings while the business only grew 20%, that's a bubble. Sell. Not just this looks interesting. I mean, you find a stock that's obviously, clearly, undeniably better than what you own. This is rare. Maybe once or twice a year. When you find it, okay, you can reallocate. If one stock grows to become 40% of your portfolio, you might trim it for risk management, not sell entirely, trim. These are valid reasons. But I'm up 50% is not a reason. It's gone up a lot is not a reason. I want to take profits is not a reason. I'm going to tell you something I wish someone had told me when I started. Your goal is not to be right a lot. Your goal is to make a lot of money when you're right. And the only way to make a lot of money when you're right is to stay in the trade long enough for the magic to happen. I bought hundreds of stocks over my career. I was right about maybe 60% of them, but my real money came from 10 or 15 stocks that I held for years. One 10-bagger pays for 9 losers and still leaves you rich, but you only get the 10-bagger if you don't sell at 2x. Most investors get a lot of 2x returns. They think they're doing great, but they never get the 10x because they sell too early. Your goal should be to find 3 to 5 stocks in your lifetime that you hold for 10 plus years. If you do that, you'll be wealthy. I guarantee it. So here's what I want you to do right now before you close this video. Action. Step 1, review your portfolio. Pull up your brokerage account. Look at your current holdings. For each stock, ask, why did I buy this? Has that reason changed? What's the current valuation? Do I have a better place for this money? If the answers are good reasons, no, reasonable, and no, then stop thinking about selling. Close the app. Go do something else. Action. Step 2, make the commitment. Pick your 3 best stocks, the ones you believe in most. Write this sentence for each one. I will hold until happens, regardless of the stock price. Example. I will hold Apple until their iPhone sales decline for 3 consecutive quarters or the PE exceeds 40, regardless of the stock price. This is your anchor. When the stock doubles and you're tempted to sell, read this sentence. Action step 3, stop checking every day. Set a reminder on your calendar for 90 days from now. That's your next review date. Between now and then, don't look at those stocks, don't check the prices, don't read articles about them. Just live your life. When the 90 days are up, review, ask the 4 questions. If everything's fine, set another 90-day reminder. Action. Step 4, learn from history. Go back and look at the 5 stocks you sold in the last 3 years. Write down what they're worth today. Calculate what you would have if you'd held. Yes, this is painful, but it's the best education you'll ever get. I guarantee after doing this, you'll be much less likely to sell early again. Remember, your enemy in investing is not the market. It's not other investors. It's not Wall Street. Your enemy is yourself, your impatience, your fear, your need to do something. Let me leave you with this. I ran the Magellan Fund for 13 years. We turned $18 million into $14 billion. We beat the market by an average of 13 percentage points a year. You know what my secret was? It wasn't that I was smarter than everyone else. It wasn't that I had better information. My secret was that I could hold a stock through the tough times, through the crashes, through the moments when everyone else was panicking. I could hold because I looked at the business, not the stock price. When I bought Dunkin Donuts and sold at $3, I was looking at the stock price. When I bought Home Depot and held through the '87 crash and beyond, I was looking at the business. That difference made me hundreds of millions of dollars over my career, and it can make you millions over yours, but only if you learn to hold, only if you learn to ignore the noise, only if you learn to let your winners run. The stock market is the greatest wealth-building machine in human history, but only for patient people. For impatient people, it's a casino. Don't be impatient. Find good businesses. Buy them at reasonable prices and hold them for years. That's it. That's the entire strategy. It's not complicated, but it's incredibly hard to execute because it requires you to do nothing. And doing nothing feels wrong. But I promise you, in 10 years, you'll look back and thank yourself for holding. You'll have wealth that you never imagined. Not because you were smart, but because you were patient. That's all. Go hold your winners.